Welcome to KiwaniTalk. We're a public information program put together by people from the Dearborn Kiwanis Club, help from students from the Dearborn High School film program, and Kiwanis members. My name is Gary Gardner, and welcome to the longest running cable access program in the entire world. We've been doing this longer than anybody else in the country and the world, and probably the known universe. We're doing it from the facilities of WDHS in Dearborn, where I was here over 50 years ago, and it's come a long, long way, and we're happy to be here. We're talking about something, though, that is not as wonderful or joyful as film, but it is taxes. And to help us talk about taxes, we have Jerry Assenmacher from Tax Solutions Center. I'm also a member of our club. And Jerry, welcome to the program.
Welcome, Gary. Right, thanks.
You know, and so taxes are a thing that are necessary. They're an evil. And what in the world got Jerry Assenmacher into the tax world? How did you start out to be a CPA?
Well, first off, there's three known facts in life. You will be born, you will die, and you will pay taxes.
So you figured you get involved in something that you're going to be involved with your life.
Yeah.
But why did you go into accounting?
I actually was in the restaurant business. And at the age of about 21, 22 years old, I decided I didn't want to any longer. So I went over to Henry Ford Community College. Well, I guess it's Henry Ford College now. And I started to take a couple of accounting courses over there.
My impression of restaurant business is that you spend a lot of hours, days and weekends and nights. My daughter's a CPA. She's an audit manager at Plant Moran, and I know that during the, quote, busy season, she's there for days and hours and weekends and nights.
Tax season, which generally runs from about January 15th to April 15th. So for those 3 months, I work every single day, 7 days a week for 3 months, and I average about 85 hours a week. But
CPAs aren't just tax people.
No.
They do a lot. Talk about some of the other things besides taxes.
Well, if you're a certified public accountant, if you're working for a larger firm, you probably are either going to be in the audit department, where you're going out and you're looking at the books of a company, and you're an independent accountant, where you're taking a look at the books to make sure everything is proper. Or you're in the tax division, where you're doing tax returns, usually mainly corporate returns or very high-end personal returns for clients of that firm. I've always been a local CPA, smaller firm, maximum employees, maybe 5 employees. We do both. We do bookkeeping work, we do accounting work, don't do auditing any longer, but we'll do bookkeeping, and mainly though now we're doing tax work. And mainly individual tax returns.
The thing about taxes too, they're not static.
No.
Every year the government says, I'm finding a new way to get money to pay for whatever the government is doing. And so there's the change. Talk about how do you keep up with the changes in the tax laws and all the things that are coming down the pike every year?
We have a requirement, as a certified public accountant, I have a requirement to take 40 hours of continuing education every year. So I focus mainly on tax work, because that's mainly what I'm doing now. We're coming up on this upcoming tax season. It's going to be my 41st tax season I've done, and so I have to take classes. So as a matter of fact, next week I'm going to be going to a 2-day seminar, 8 hours each day, that all we're going to talk about is preparing individual Form 1040s tax returns, and what the changes are and what we should be looking for and whatever the hot topics are. This year we have some big hot topics because of the new tax law.
Before you get, I want to say, thank God I'm an attorney, that we don't have to do CLE, continuing legal education. They tried bringing it out for the young guys about 20 years ago. Young guys being lawyers, they said, old guys don't have to do it. We're grandfathered. We're not going to do it. So no CLE, no mandatory, but I do take a lot of stuff on. I do keep up with what's going on.
We still have to do 40 hours. We still have to do 40 hours every year.
But back to the tax season coming up, it seems that I heard this year that there was this big, beautiful something or another that
Yeah.
is going to have some major implications for all of us as taxpayers. And what was that? What was the idea behind it, if you know?
All right. So the new tax bill is called the One Big Beautiful Bill. President Trump came up with the name of that. It was signed into law on July 4th of 2025. What it did was when Donald Trump was the president his first time, when he was 45, now he's 47 obviously, but when he was in office before, they passed a tax bill that basically rewrote many of the tax laws in 2017. Those were due to expire at the end of this year. So January 2026, if we didn't get a new tax bill, all of the tax law changes that were made back in 2017 would revert back to those laws.
As I recall, that was an enormous tax cut.
Yes.
And the effect by going, if the tax bill is not renewed or changed or kept in some form, we would have had the biggest tax increase in the history of the country.
Yeah, there would have been some. I don't want to say devastating, but there would have been some huge changes in how you file your tax returns. We'd be going back to the old law. So they had to get this thing pushed through, and they had to make it effective for the beginning of 25, even though it wasn't passed until the 4th of July.
So as a taxpayer, and I'm sitting here in November 2025, not much for me to worry about right now, or is there, in getting ready for 2026?
Oh yeah. So some of the changes, most of the changes actually are occurring for 2025, but there are some changes that aren't going to be occurring until 2026. Probably the biggest non-change to all of this is that the law that was passed starting in 2017 was declared permanent. Permanent means for as long as Donald Trump is president. The next president could come in and write a new law that would supersede this. But for now, we don't have the issue of having to go back to pre-2017.
In other words, and unless there's a new president, new Congress, and they pass Senate, House, and you sign, it's going to be here forever.
It's going to be here forever.
Okay.
But permanent in the tax world is never permanent.
Okay.
So the biggest thing that they had to do was back in 2017, all of the tax rates were cut. They were, back then, I think the lowest rate was 15%, and the tax bill back in 2017 dropped to 10%. So the tax rates have remained the same. They are now permanent. 10, 12, 22, 24, 32, 35, and 37%.
But so let's talk about that. It's to get to 35%.
You got to be making a lot of money.
Making more than $17 an hour.
Yeah, you're making a lot of money, and it's what they call graduated rates. So with graduated rates, it means, for instance, the 10%, if you're married filing jointly, the 10% rate, I'm just going to round it and say it's $10,000. So the first $10,000 gets taxed at 10%. Then you jump to the 12% rate. And the 12% rate runs through another dollar amount. And then, so those dollars from 10 till 75 are taxed at 12%, and then it just keeps going
Just for
up.
an example then, if you had $10,000, 10%, you pay $1,000 tax on the first $10,000.
Right.
Then say it was 12% on the next $10,000.
Yep.
You pay $1,200 on that. So by the time you get to $20,000, you're paying $2,200.
Right.
But the rate increases not exponentially,
As you
but
make
higher.
more money, the more higher dollars get taxed at a higher rate, and the cap is the 37% tax
But
rate.
aren't there exemptions to your income? You don't have to pay tax
Oh, yeah.
on your first dollar, though, right?
Yeah. So one of the big changes in 2017 that has now become permanent with the One Big Beautiful Bill is that the standard deduction was almost doubled back in 2017. and it has now become permanent. So for a married filing joint couple, they get automatically, unless they can itemize, which I'll explain in a second, they automatically get the first $31,500 of income is tax-free. So you don't start that 10% bracket till you hit $31,500. So, and that's where the 10% bracket starts. That's what's called your standard deduction. Single taxpayers, basically half of that 31,500 is your
$16,750, right?
Yeah,
Yeah.
I think it's like 17,000. Yeah.
Okay.
So if you've got if you're single and you've made $17,000 that year, you're not going to pay any income tax.
Federal tax.
Federal tax. Yeah, you
State of
could.
Michigan.
State of Michigan, you could.
Yeah, they're a little different.
They're a little
bit
different. The
meaner on that.
exemption for state of Michigan is just something. It's just a little bit short of $5,000. So you're still going to pay Michigan taxes, but federal taxes, if you're single, approximately the first $17,500 is tax-free.
Is it possible then you pay no federal tax, but you'd owe the state of Michigan some income tax?
Absolutely.
Wow. Okay. So.
Oh yeah. I actually see that all the time. Yeah, where you are paying Michigan taxes, but Michigan tax rates are much lower. State of Michigan income tax rate is what they call a flat tax. That was a big thing back years ago. They said, oh, we can make the tax code so much simpler for federal income tax if we just make it a flat tax. We have a flat tax in Michigan. It's 4.25%.
Still have my tax form that I don't really understand because I have someone do it who knows what they're doing, thank God. But there's still pages and pages and pages just to get to that 4.25%.
Oh yeah, yeah. You've got Social Security is not taxable for the state of Michigan. If you've reached the correct age, which I believe is you had to be born prior to 1960 for this year, they've brought back the exemption for pensions that is not taxable for Michigan to a certain degree is what you get to deduct.
So another one side question before we get, we're taking a break in about a minute and a half here. So
okay,
but how can then, if there's these massive exemptions and deductions and things, how can a tax advisor like from tax solution centers like yourself, Jerry Assenmacher, how do you advise someone to do? Is there any way to beat the system with that?
There's no way to beat the system, but there is some things you can be doing, to make sure that you're taking as much of an advantage as you can on getting the best tax rates.
Dumping money into your IRA for.
Well, I will tell you right now, there's probably the thing that, especially if we have any young listeners out there, they ought to be funding. If they're maybe a young college student that's working part-time, they should be funding whatever they can for retirement. But with that in mind, I would also then tell them at that age, they ought to, instead of putting it into an IRA, they ought to put it into a Roth IRA and pay the taxes now.
Rather than later.
Rather than later, yeah, because all that growth is tax-free.
The sad thing I see in my practice, and I'm a divorce attorney, I see people who have an IRA or 401k. They use it as a savings account. I just had a client talking to today. Yeah, I needed $2,000, so I took $2,000 out of my IRA, my 401k to pay some bills. That's a whole other discussion about planning.
Oh, especially if they haven't reached retirement age, because not only are they paying the income tax on that, they're also paying a 10% penalty. So if they took $1,000 out of their IRA before they reached the normal retirement, which is 59.5, yeah. If they took $1,000 out, IRS automatically takes $100 of it.
Which is crazy.
Plus paying income tax, because they don't want you touching it.
It's a disincentive to be stupid, but people still are.
Oh, yeah.
But we're going to take a break here. We'll come back and get into the, Jerry's got pages and pages of stuff he's all set to talk about, and I've been distracting him, but we'll come back. Jerry Assenmacher, the president of Tax Solutions Centers. Tax time's coming up. Don't go away. It'll get really exciting in a minute, trust me.
I am Kiwanis. I believe in people. I care about service. I seek out connection. I matter to my community because my community matters to me. I reach out to others. I reach inside myself because I am Kiwanis. I know a good cause when I see one. I know a kindred spirit when I meet one. I know the impact we make together when our need to help meets our willingness to act. I am Kiwanis. I take notice. I take pride. I take action. I take the opportunity to make a real difference in the life of a child, in the life of my town, in the part of myself that grows stronger by working and serving with others. I'm here. I'm inspired. I am Kiwanis.
Welcome back to KiwaniTalk. I'm your host, Gary Gardner. We're talking about taxes. Taxes are a necessary part of our lives, and to talk about them and what's coming up with the changes through the big, beautiful bill is Jerry Assenmacher from Tax Solutions Centers. Jerry, I've been distracting you. Go through some of the things that you think are important for us here.
All right, so I'm gonna give you some examples of things that I'm getting phone calls about right now. All right, we already talked about the standard deduction for that everybody is entitled to, and I'm going to give you the exact. I'll give you the exact numbers on that. So the married filing jointly, the deduction is $31,500. If you're single, it's $15,750. So because those numbers were doubled from where they were in 2016, most people haven't been able to itemize their deductions because there's so few things that they actually can take. So the way the tax works is you get the larger number, the larger number of the standard deduction or what they call your itemized deductions. So your standard deduction if you're married is $31,750. Your itemized deductions consist of things like your state income tax, your property taxes, your mortgage interest, and your charitable deductions. Those are the big ones that are out there. Well, up until this year, your state taxes, that would be your property taxes and your Michigan income tax, were all capped at $10,000. So if your property taxes were $20,000, your Michigan income tax was $5,000, you didn't get to deduct $25,000. You only got to deduct $10,000. That has changed with the big, beautiful bill. The big, beautiful bill has raised that up to $40,000. So instead of being able to capping at 10, it now caps at $40,000.
That's a gift to California and New York taxpayers.
That is for the high rent districts of the country,
right.
Yes. I don't believe in a lot of cases people who were not able to itemize before are going to be able to itemize now. Where you are, I might see it a little bit more is people who own second homes. They've got a place down in Florida. They got a place up north. Their property taxes are they're paying a little bit more than other people. The one other big change that they made, and not really big, but it is something that is going to affect a lot of people, is that even if you can't itemize, and again, the difference is if your itemized is above $31,500, you take that number. If it's below $31,500, you take $31,500 as your deduction that you get, or that's the amount of your income you don't have to pay income tax on. They changed one item though, and now even if you take the standard deduction, you take the $31,500, that's for married filing jointly, you are still allowed to deduct $1,000 of charitable contributions, even if you itemize. And I believe it's $2,000 if you're married filing jointly. So that is sort of a little extra. They want people to be giving the money away to charity. So, and those are what they call 501c3s. They got to be charitable organs.
It's like the Salvation Army or Kiwanis Club.
And it's got to be cash.
Okay.
Oh, it's the Kiwanis Foundation.
Kiwanis Foundation, sorry.
Yes. So, and it also has to be a cash contribution. Now, a couple other things. For those that have children, the child tax credit, which was $2,000 if your child was under 18 years of age, 17 or younger, you could possibly get, and there's income limitations on all of this, but you could get up to a $2,000 tax credit per child. That is going up to $2,200. For our seniors out there that are watching the program,
like Jerry, yeah.
Yeah, like me. If your income levels are low enough, and it is $75,000 for a single person, $150,000 for married, you could in fact get what $6,000 of your Social Security could automatically be tax-free. But again, that is subject to some income tax rules as far as that goes.
How about, you worked in the restaurant business, how about taxes on tips? What about,
okay.
What's on that?
That's one of our two big ones. Taxes on tips and no taxes on tips and no taxes on overtime. No taxes on tips is up to $25,000 of your tips. If you're in the tipping industry, and they have really sort of designated what is considered normal tipping industries. The restaurant business, the beautician type of business, those type of businesses. Up to $25,000 of your reported tips are no longer going to be subject. Again, there's income limitations on that. Will not be subject to income tax. But it's still subject to Social Security tax, still subject to Medicare tax, and unless your state, which the Michigan has done this, unless your state has said that tips aren't taxable, it's subject to state income tax. Michigan has passed a law. If you're a tipped employee in Michigan, your tips are not, up to $25,000, are not taxable for federal and for state. The other one is overtime. We now have up to, I believe it's $12,500 for a single person. That might be the, I'm sorry, that is the tipped amount is the $12,000. Let's see, certain taxpayers will receive a deduction of $12,000 for qualified, yes, $25,000 for tips. So if you're a single person, up to $12,500 of your overtime pay is no longer subject to income tax. $25,000 for married filing jointly. So what that means is, again, you are going to pay Social Security and Medicare.
7.65, right?
7.65 total on that, but you're not going to pay income tax. But it is only on the premium overtime amount. So in other words, your standard rate is $20 an hour. You get time and a half for any hours you work overtime. So you get $30 an hour. The only exemption is on that $10 per hour overtime premium. It's not on the whole amount that you earn on that hour.
The government giveth and the government taketh away.
Yeah, your W-2 wage statement, employers are just scrambling to get these all, correct. But yeah, that's all going to have to be spelled out in your W-2. You just can't tell You can't tell the IRS when you file the return, well, this amount was overtime. It has to be on that W-2.
Okay, we're down about 3 minutes, so keep going here.
Okay, so some other things. For those of our listeners who like to frequent the casinos in downtown Detroit, you used to be able to deduct your losses all the way up to your winnings, 100%. If you hit on a slot machine for $2,500 and you can prove that you had spent $2,500, you could deduct that if you could itemize. It's only going to be 90%. They want the gamblers paying at least something.
A little syntax there.
Yeah, a little syntax. Again, there is the standard deduction. Oh, here's a big one for those young parents. Starting in 2025, if you had a child in 2025, and this is going to be for 2025 to till 2028, I believe, you are allowed, they're not funding these yet. It's not going to happen until, I think, sometime in 2026. You can, the government will open an account in your kid's name, only for those born 2025 to 2028. The government will open an account of $1,000 and put it away for your kid.
Which you're going to have to apply for.
You got to apply for it. And you can also put non-deductible contributions into that account. And that child can start using that money at the age of 18, either for education purposes, for home purchases, or they can just save it for retirement. But the government's going to put, and believe it or not, it's called the Trump account.
Hard to believe that. So the thing too is that if you were a young person in your 20s, you put $100 a month away every month into a Roth account for the rest, for 10 years.
Yep.
By the time you turn 65, it'd be an enormous amount of money.
Yes, yeah.
So
I highly recommend to any young person who is getting if their company has a 401k plan and they offer a Roth one, pay the tax now, because you hope that your investments double about every 10 years.
So, well,
Yep.
Jerry, we're down to our last just bit. How do people get a hold of Jerry Assenmacher at Tax Solution Centers?
I'm currently on Monroe Street in Dearborn.
Phone
I'm in
number?
the Dearborn Area Board of Realtors, 313-277-5800.
And you'd be happy to talk to people and set them up to help with the consultation.
Absolutely.
Want to thank you for tuning in. I also want to remember Skip Armstrong, who was part of the KiwaniTalk show for many, many years. Skip passed away in the last week. We miss you, Skip. We hope that you're watching us and giving us some tips. But we'll be back next time. Jerry Assenmacher will be back next year with more tips. I'm Gary Gardner. See you next time. Bye-bye.